Welcome to the Commercial Property course, presented to you by the Commercial Property Institute. I'm Steve Palise, and this is an all-encompassing, detailed course on everything commercial property. Not only is it the most comprehensive course you'll find online, but it is the only course on the market that will help you truly understand all aspects of commercial property. This course aims to equip first-time investors, experienced investors, and even buyer's agent with the essential skills to conquer the dynamic real estate market. And the best part is, you'll be guided by me through the entire process. So why am I offering this course? I've found that Australians love talking about property. They also love investing in property. But people often stick to residential because it's considered easier and safer, and there's a lot of information available. Commercial property, on the other hand, is viewed as somewhat risky, when in reality, it's just not really understood. So this brings us to where we are now. There's a gap in the market and a need for a concise, all-inclusive set of information about investing in commercial property, and I want to share this information with you. The dynamics of commercial property are absolutely different, but not necessarily more complicated. We just need to become better educated around it. I'm so passionate about helping educate you on commercial property that as part of this course, you receive a free copy of my commercial ebook, Commercial Property Investing Explained Simply. Throughout the course, you'll also have access to a plethora of Excel spreadsheets, tools, checklists, and resources to help you on your property journey. Of course, I do need to include the disclaimer that this course is not financial advice, and all opinions expressed by an instructor are solely their own. Please seek professional advice before making any financial decisions. So let's go over what's covered in this course. Over multiple modules, we'll unpack the question of why invest in commercial property and explore the different commercial property types, including industrial, retail, and office. We'll then move into crunching the numbers and how to use objective measurements to determine whether a property is a good investment. Next, we look at buying and selling properties, including how to get yourself prepared and what the acquisition process entails. Of course, undertaking due diligence, or DD, is the most important step in buying commercial property. Don't worry, we have an entire module dedicated to understanding the initial due diligence you need to perform, plus area research, how to perform a tenant and business analysis, building and pest inspections, and our own due diligence checklist. This will be a key module that will give you real information, checklists, and templates to ensure you understand all the moving parts with commercial property. After that, we'll move into looking at the conveyancing and legal side of property transactions, from exchanging contracts all the way through till settlement. Finance and lending is the next topic, including knowledge of the various types of lenders and loans available for commercial property and unpacking the entire loan process. Our next module will be everything you need to know post-purchase. This includes understanding property management, how to select and manage a tenant, potential value-add opportunities, and how to survive potential downturns. Another module offers market insights, which will include data trends and reports you can download at any time to stay up to date with the Australian commercial property market. Our final module will cover the question, what's next? It will contain an overall summary of the commercial investing process, plus additional resources and documents. How brilliant does that sound? I can't wait to share lots of information, examples, and real-life knowledge you can use in your commercial journey. The great thing is the course is self-paced and you can move through the information at your own speed and re-watch or revisit any part of the course at any time. All the videos and materials are available as soon as you begin the course. You'll also find a range of downloads that you can save and use, including spreadsheets, tools, and resources. For example, this lesson has a self-reflection worksheet that you can download and use to help reflect on each module or lesson. I encourage you to work through the course in the planned order to get the information in the most logical order, but you can search and navigate around if you need specific information or want to revisit a topic. You can also download a PDF of this lesson with the course outline and module resources. With the right education, I believe that any everyday Aussie can tap into the huge cash flow advantages of commercial property and build a resilient passive income stream against fluctuating interest rates. I'm so happy that you're here and have decided to take the next step in your journey with commercial property. Let's get started. Hey guys, I'm Steve Palise. Currently, I've become one of the most successful commercial buyers agents in Australia, but I had humble beginnings in a gentrifying suburb of Wentworthville in Western Sydney. My father was a television repair technician, my mother was a stay-at-home mum, and I had 2 older brothers to compete with. We never felt poor and were always cared and looked after. Fast forward to high school and I finished in the top 1% of the state. Yep, little bit of a nerd. At the time, I thought achieving all that academic excellence would mean wealth. I also thought that wealth would automatically mean happiness. I was also lucky to have a good knack for mathematics and theoretical concepts, so I headed on to study engineering at university, which I managed to finish at the top of that course too. After university, life progressed pretty well. I started reeling in money and climbed the ranks as one of the youngest engineers in Australia to be chartered in both mechanical and structural engineering. I've always loved design, but in engineering, there's not a whole lot of room to be subjective. It's all about the numbers. And even though I had experience in a long list of design jobs, ranging from medical equipment to mine sites, I found myself caught up in the rat race. I was working long hours, earning a good salary, and creating consistent wealth. But those who were unqualified around me continued to gain the promotions and earn even higher incomes. Some of the most qualified colleagues worked as hard as they possibly could and still went unrewarded. And so, when I thought back to my belief that academic excellence and hard work would be enough, I've suddenly felt lost. That's when I decided I didn't want to live the life of a professional that felt bound by limits. I didn't want my financial future to fall into the hands of a faceless corporate machine. I bit the bullet and dug in my heels, choosing residential property as my new path to financial freedom. And I worked endlessly to understand all the nooks and crannies, reading every property investment book out there. I also spoke to anyone in the industry that bothered to give me their time. I tried to do absolutely everything I could to make it work. After 3 years of research in 2012, I bought my first investment property in Western Sydney for $230,000. 1 year later, that figure rose in value by $80,000. That was $20,000 more than my yearly salary at the time, and it was my light bulb moment. I was hooked. From then on, I purchased more properties, and as the years went by, my portfolio started evolving rapidly, and I woke up one day and decided to finally leave my engineering career to go full-time into property. I became a buyer's agent and helped grow a buyer's agency into one of the largest in Australia. Within a few years, I was lucky enough to help my clients purchase more than 500 properties in the residential space. But here's the truth. I was always fearful of commercial property. Like everyone else, I'd heard that it was risky. I was told commercial properties meant no capital growth and they came with long vacancy rates. From all I heard around me, commercial property was only for high net worth individuals. Something sparked in me though, and I decided to research anyway. That's when I discovered all the misinformation that was just a giant misconception. The truth is, the returns on commercial property can be enormous if you compare them to residential property. And in this course, you'll see you can mitigate a lot of that risk by managing your due diligence correctly. For me, commercial property was the game changer, providing an instant passive income and financial freedom. I've now purchased more than 1,500 properties in the residential and commercial space combined, and am extremely blessed to live off my passive income. My family and I have enjoyed traveling for the last 2.5 years, and in that time frame, we've lived in 15 countries. I now have a daughter, and this passive income has given me the freedom to enjoy my time with her and watch her grow little by little. Not many can say the same, but you can, if you follow the information in this course. I look forward to presenting this course to you and help it improve your education. If you'd like to ask questions or reach out, you can send me a message on the website or find me on social media. Thanks for watching, guys, and I hope you enjoy the course. Welcome to the first module. Here we'll dive into why commercial property is worth investing in, specifically looking at the differences in residential versus commercial. Let's start with a simple question. What actually is a commercial property? Well, it can be defined as buildings and land that are intended for profit-generating activities rather than a typical residential purpose. Before you consider buying any property investment, you need to decide on your goals and ask the question, what will make me happy? Take some time to think about it now. For some people, it will be leaving a job that they hate or spending more time with their family. For others, it may be going on a holiday or buying a new sports car. Everyone's compass for happiness is different. So ask yourself, why are you doing this? What motivates you? If you try and shoot for the stars and that's not going to make you happy, then you are generally just taking on unnecessary risk. A lot of people overestimate what they need to achieve their happiness goals. So always be realistic and truthful to yourself. This leads us into what we all love, property. Investing in property is a great way to grow your wealth and secure your financial future. Deciding whether to go residential or commercial property can be difficult, but the majority of investors will choose residential. So why is it that residential is more popular? As everyone lives in some form of residential property, people feel they understand it and have a grasp of it. Shelter is considered a human necessity, so everyone needs a house to live in and a roof over their head. But where did that roof come from? What people fail to understand is that commercial properties actually provide the resources and services necessary for our survival, including building residential properties. The media also plays a huge role, with daily stories about people making money in the residential property market, making it seem more achievable and mainstream, whereas commercial investing is barely spoken about. Another big difference between residential and commercial is emotion. According to the Australian Bureau of Statistics, in 2021, nearly 70% of residential households were owner-occupied. The owners of these properties have emotional attachments as it's their home. By comparison, commercial property is typically bought as an investment without emotion and is purchased based on the numbers and financial return. Think of it this way. You generally don't fall in love with a warehouse. You are only doing it for financial benefit, and that's what makes it easy to buy and sell commercial property. With emotions driving up the price of residential property, the yields you can now expect from them have come down significantly. These days, residential may no longer be as lucrative as you would think, and this has forced people to start looking at other options, like commercial. Investing in commercial property is becoming increasingly popular as the cash flow returns and high yields are drawing investors in. In general, commercial returns are much higher if you get it right, but they can be riskier if you buy a bad property. Comparing this to residential, if you buy a bad residential property but in a good suburb, you'll generally be okay long term. Being a buyer's agent, I've worked on both residential and commercial purchases, and I can see value in both. It all comes down to what you're trying to achieve over what time frame versus what your risk profile is. While there are risks involved with any investment purchase, buying commercial property simply comes down to personal preference, due diligence, and having the right advisors on your team. My goal during this module is to educate you on the differences and similarities between residential and commercial property. Despite the fact that this course is all about commercial, I will definitely say that commercial property is not for everyone. The knowledge you learn will help you make an informed decision whether or not you're at the right stage for a commercial property investment. So, why commercial property? What are some of the benefits of investing in commercial property? These are strong passive income, higher rental return, stability of income, the tenant pays the outgoings, annual rental increases, longer leases, negotiable lease terms, quality tenants, ability to add value, and tax benefits. Commercial property has a plethora of options and types, including industrial, retail, office, and specialty like cinemas, car parks, or petrol stations. Basically, every type of business you see on your daily travels is essentially a commercial property. You will also find that some of the best properties have versatility, and there is a crossover. For example, sometimes a medical centre is an office space. Other times it's a retail space. It can even be a converted residential property. We'll cover this in more detail in the next module. Most residential property investors know that it's very possible to purchase a property with a loan-to-value ratio, or LVR, of up to 90 or 95%. For commercial property, the reality is you're looking at an LVR of 60 to 70%, sometimes as high as 80%. But why won't the banks lend you as much money? Well, this is because commercial property is deemed riskier in their eyes, and the LVR is lower to protect their interests. Coming up with this initial deposit is generally the main barrier to entering the commercial property market. A huge benefit of high quality commercial property is that it has the potential to pay itself off in 10 years, compared to the traditional 30 years of residential property might take. That means all of the passive cash flow goes straight into your pocket, and once a debt is lowered or paid off, you open up the possibility to leverage equity and purchase a second, third, or fourth property. While this course is all about commercial property, there are times when commercial property may not be right for you. As you are using a much larger deposit, you are losing out some of the benefit of property, which is leverage. Leverage means using other people's money to maximize your returns. For example, if you're a younger investor and you were just starting your property journey, you might be better off buying 3 properties on 90% LVRs versus 1 commercial property on a 70% LVR. This will allow you to have a portfolio that is 3 times as large and reap the rewards of capital growth. Then, over time, you'll be able to make the transition into commercial property and use the equity as a deposit. On the flip side, if you're a 60-year-old who is looking to retire in the next 5 years, then there will be no point in going out and buying a neutrally or negatively geared residential property, as this does not help with your retirement. If your aim is to maximize the power of leverage and put in the least amount of capital, then residential investment may be more suited to you at this stage of your journey. But if your goal is to achieve a high yield and be cash flow positive from year 1, and you have access to cash or equity, then commercial investing is your answer. I believe it's essential to never invest in something you don't understand, as it can be risky, and unless you seek reputable investment advice, this could be a huge mistake. Throughout the course, I will help you build knowledge around commercial property and how to analyze, select, and buy commercial property. A well-chosen commercial property should provide a consistent return on investment and over time increasing both rental and property value. Well, that brings us to the end of the lesson on why commercial property. See you next lesson. Welcome to lesson 2, where we're going to compare the main fundamentals in residential and commercial property. Let's get started. Property investors often debate whether to go down the residential or commercial avenue for investment. So, how can you decide whether commercial property investing is right for you? Let's look at some of the numbers and key differences between the two. You'll find the Comparing the Fundamentals table in the download section of this lesson. The figures used in the table are indicative only and will vary between properties. We will go through all of these in more detail later in the course, but here is a general overview of each so we can compare the main points between residential and commercial. Firstly, deposits. Commercial properties require larger deposits than residential, and this is one of the big disadvantages that people will have with commercial properties. Lenders generally allow a loan-to-value ratio, or LVR, of only 60 to 80% for commercial property, whereas residential property lenders will allow LVRs of 80 to 90%, even up to 95%. Generally speaking, you'll need a 10 to 20% deposit for a residential house or apartment compared to a 20 to 40% deposit for a commercial property. The perceived disadvantage is the high cost of entering the market. However, you can get into a commercial for as little as $50,000 for a car park or regional office. Buying a small warehouse for as little as $150,000 is not unheard of. Because of the high cash flow, you can often make up that extra deposit in the first couple of years with the cash flow alone. It's very unlikely you'll find a residential property for that price. Another big difference between residential and commercial is the required level of due diligence, or DD. Commercial properties require an enormous amount of due diligence as there are many moving parts that can take days, weeks, or even months. It requires you to investigate the asset type, vacancy rates, foot and road traffic, perform building and pest inspections, lease reviews, and tenant and business analysis. On the other hand, with residential, as long as you buy in a good location with a solid house, you'll generally be okay long term. We have a whole module dedicated to the grueling process of due diligence. Next, we have yields. The yield of any property is the annual rental income you'll receive from the tenant over the purchase price. Commercial properties generally provide a greater rental yield compared to residential. This is one of the biggest advantages when considering a commercial investment and might even be why you decided to take this course. Residential yields are typically between 3 and 6% gross, whereas commercial yields can be 5 to 8% net. Be mindful of those words I just used, gross and net. Residential is considered in gross yields, and that's because as the owner, you are responsible to pay all the outgoings such as council rates, water rates, and maintenance. This can bring the net yield down to approximately 1 to 3% after all the outgoings. Whereas in commercial, when we say 5 to 8% net, that is actually money in your pocket as the tenants are responsible for the outgoings. So when you see a 6% yield on both residential and commercial property, these are definitely not the same, and one will result in a much higher cash flow. Leases on both commercial and residential properties can be as little as month to month, but generally speaking, commercial leases are from 1 to 30 years. Residential leases tend to be 6 to 12 months. Over time, commercial leases have become less convoluted and easy to understand, but it is still recommended for your solicitor to review the lease. Here's a fun fact for you. Did you know that the longest lease signed was in 1759 by Arthur Guinness, the founder of Guinness Brewery? He signed a lease on the brewery in Dublin for 9,000 years. Commercial tenants will often sign these longer leases as they want the security of knowing they can remain at the location long term because their business and livelihood depends on it. A rental bond is money you can ask the tenant to pay as financial security when they agree to lease the premises. It can help protect the owner if the tenant defaults on their lease. Residential properties usually have a 1-month bond, while commercial properties typically have a bond of 1 to 6 months. In commercial, you can also have a bank guarantee. This is a formal assurance by the tenant's bank that an amount of money will be paid to the landlord if the tenant does not fulfill their obligations under the lease agreement. In terms of evicting a commercial tenant, it is a much simpler process with less red tape as the property is not their home, whereas evicting a tenant in a residential property can take months and involves complicated legal proceedings. Next, let's look at vacancy rates. Vacancy is normally people's biggest concern with commercial property because it means having a property that will sit empty for a long time. Don't get me wrong, that can happen, but generally that's because they bought the wrong property. Often people hear one horror story or they see a vacant shop near where they live has been vacant for a few years and they tarnish all commercial properties with that story. With small warehouses, you will generally cycle through a tenant more regularly as they will either outgrow that space and move or close up shop. These warehouses are more in demand with sole traders or small businesses and in good areas can generally be filled in 1 to 3 months. Whereas in large warehouses, you will have that tenant for longer, potentially 5, 10 or 20 years. These tenants are less likely to leave as their livelihood is attached to the business and they've already paid for the fit out on the property. They've also built their reputation there. But when they do leave, you'll probably have 12 to 24 months vacancy as fewer large businesses can move into that space. In saying that, as of 2023, vacancy rates have come down to an all-time low. As you can see in the graph, these are the vacancy trends for industrial properties. The vertical or y-axis shows the average vacancy rate percentage and the horizontal or x-axis shows the time frame, starting from the second half of 2019 to the second half of 2022. For the last few years, in most capital cities, we have seen vacancy rates drop to less than 1%. This graph shows Sydney at 0.2% vacancy rate in the second half of 2022, which is on par with residential. While vacancy rates can be a potential issue, if you buy in the right area where vacancies are tightening, you will have a great investment. Residential properties usually cycle between tenants every couple of years and have a vacancy of 1 to 2 weeks between tenants. Over 10 years' time, it's not that much different in having a vacancy period of 3 to 6 months for commercial. It's the same net result, but you just feel it more with commercial during that extended period. An important consideration here is being able to afford the loan if your tenants move out. People sometimes argue that commercial investment is riskier in terms of vacancy, but that's only true if you've bought a risky property. It's the same as buying the equivalent of a residential investment in a mining town where rental demand is tied to the state of the resources sector. Even with a good commercial property, you will still need a bigger cash buffer to cover aspects including longer periods of vacancy. Let's look at outgoings, which is a huge difference between residential and commercial. As mentioned before, with residential properties, the owner is responsible for most costs, such as council and water rates, repairs, and maintenance. So if these go up, then more money is coming out of your own pocket. With commercial property, the tenant is typically responsible for most outgoings. Council rates, water rates, maintenance, all paid for by the tenant. This means a much higher cash flow return for the owner. In most cases, commercial tenants are responsible for the property's maintenance and the repair costs, as well as the internal fit out and the shop front. The condition and appearance of the property reflect on their business, which means they're more likely to look after the premises and complete repairs to make a good impression to their customers. In some cases, the property's presentation can specifically be stipulated in the lease. So if the tenant does not keep the property to a high standard and complete repairs and maintenance, the tenant is at risk of breaking the lease and having it terminated. In contrast, residential tenants cause wear and tear, and these maintenance bills are all covered by you as the owner. Depreciation is the loss in a property's value over time due to aging and wear and tear. Depending on the age and style of building, a commercial property will usually have a higher depreciation due to the more expensive construction and fit out. So this can be an advantage as high depreciation means greater tax deductions for the owner. Residential property investors generally have a lower depreciation because they have limitations regarding the plant and equipment deductions they can claim. Okay, let's look at property management. Residential properties require considerable effort to manage because the landlord is responsible for the outgoings, maintenance, and repairs. With shorter leases and more tenant turnover, the property manager has a lot more communication with the owner. With commercial properties, the tenants are usually responsible for the outgoings and maintenance, so they require less work on the part of the owner. As mentioned before, they're also more inclined to take care of the property as their business success relies on it. One of the few negatives of commercial property is that the interest rates are slightly higher. It's not a lot, generally 0.5 to 1% higher than residential, depending on the type of loan, deposit amount, type of property, and the risk. Often the loan term is shorter too, either 15, 20, or 25 years instead of your standard 30-year with residential. There are even commercial loans called lease stock loans, which are for the length of the lease itself. A big misconception is that commercial properties don't grow. This is a complete myth. Most commercial properties have shown at least the same growth as residential properties. It just happens in different cycles most of the time. You can't encapsulate all commercial properties under the same banner for capital growth. A high density office space will grow completely different from a warehouse and different to the shop on the corner. They all have different land components, various uses, and different demand. I've heard people say invest in residential because it's always safe because people need a roof over their heads. I always respond with, well, where do you think the roof came from? We will always need commercial property, manufacturing, wholesalers, distributors, storage. You need all of these for the economy. Residential property is dependent on the market and growth is typically cyclical with periods of high growth, low growth, no growth, and even negative growth. By comparison, a commercial property with a solid tenant will typically remain at the same price or grow due to the annual rent increases. Both residential and commercial can add value. Often we see residential property investors renovate, buy larger blocks and then build granny flats or even subdivide the property. While these can be profitable, that's usually the most value the investor can add. The benefit of commercial is that it is so versatile and there are a number of value add possibilities, including changing the property's use, adding more tenancies, increasing the rent, creating new sources of revenue such as installing ATMs or solar power panels, renting out parking, storage or advertising space, or even adding mobile phone towers and repeaters on the roof. All of these will help you to increase the property's rental return, which will increase the property's value. The last fundamental we're going to look at is cash flow. Commercial property has a high cash flow and servicing the loan is less of an issue, meaning that as an investor, you can keep expanding your portfolio. In contrast, many residential properties are negatively geared, meaning you're losing cash flow in the hope that the capital growth will outweigh that loss. By buying this way, you'll be reliant on your job to be able to pay the mortgage. Of course, it is possible to find good quality neutral or slightly positively geared residential properties, but you'll often run into serviceability issues after a few properties as lenders often shave down the rental return and push up interest rates during their calculations to mitigate the risk. You may also find that if interest rates rise, your residential property will become even more negatively geared and you must dip into your own pocket. Of course, those are just words. Let's have a look at the actual numbers with a simple example. Firstly, we bought a residential house in the southern suburbs of Brisbane. The purchase price was $700,000 and we are getting $600 a week in rent, so a total of $31,200 a year. We have taken out a loan of $560,000 on an 80% LVR and will be paying 5% interest-only repayments. When we add up all the expenses such as loan interest, council and water rates, maintenance, etc., we have expenses of $35,300. So we have our $31,200 rent minus our $35,300 in expenses. That leaves our yearly cash flow at a negative $4,100. As this is just a simple calculation, we are not including tax depreciation benefits or negative gearing implications. This is solely looking at cash flow. Next, we have a commercial warehouse, again bought in the southern suburbs of Brisbane for $700,000 at 6% net yield. This brings in $42,000 a year in rent. As the tenant pays the outgoings and expenses, we only have the loan interest to deduct. Generally, for commercial property, you would have a 70% loan to value ratio, but for ease of comparison, we'll use 80% LVR. Again, we have $560,000 loan on an 80% LVR and we'll be paying 5% interest-only repayments. So, at the end, we are left with positive $14,000. As you can see, the commercial property has a much higher cash flow for the same outlay as residential. This is only one of the huge benefits of commercial property. Now that we have compared the main numbers and key differences between the two, which one will you be going with? While I hope you said commercial, every investor is different and it's important to decide your goals and what you want to achieve. Commercial property was a game changer for me and allowed me to achieve financial freedom by providing an instant passive income. When comparing the fundamentals, commercial property has both advantages and disadvantages compared to residential. Throughout this course though, you will see that with careful choice of property and location, commercial investing can lead to significant returns. Still don't believe me? Why don't we crunch the numbers and look at a more detailed example? Jump into the next lesson where we compare residential and commercial property using the cash flow calculator. Thanks for watching and see you next lesson.